Good afternoon and a very warm welcome to ESG Risk AI's virtual event, ESG, Embedding Responsible Corporate Practices and Sustainable Investment. My name is Inga Rühr. I'm the strategy consultant at ESG Risk AI, and I will accompany you today through this event. I'm very happy to see so many people having joined and are joining as we speak the platform. And I would like you, first of all, to thank you for taking time out of your busy schedules and being here today. Let me give you a short introduction to the event. Today's event provides a platform for exchange on ESG in India. We will also share insights from our ESG assessment of the top 500 listed companies. I'm really happy to be joined by a wide range of eminent speakers. We have Mr. Robert Patalano, Acting Head of Financial Market Division of the OECD, who will give an inaugural speech. Then we have 4 panelists, Mrs. Surabhi Gupta, General Manager at Securities and Exchange Board of India, Mrs. Somia Rajan, Founder and CEO of Waterfield Advisors, Mr. Swarup Mohanty, CEO of Mire Asset Investment Managers, and Mrs. Ruby Oja, Senior Environmental and Social Development Specialist at IFC. Welcome to all of you, and thank you for being here today. One small organizational aspect before we start. We are having a question and answer session at the end, which will be after the panel, and where all the speakers will be present to answer questions. You can post your questions in the chat box or send them by email, and we will try to either way answer them in the question and answer session, or also while the event is going, we will have a team that is answering your questions directly in the chat. Before starting now, I would like to invite our CEO, Shankar Chakraborty, to give a short welcome speech. Shankar is the CEO of Equity Ratings and Research and Chairman of ESG Risk AI. Shankar, over to you.
Thank you, Inga. I am extremely happy to see a good number of people already on board. Inga, I have a little bit of an echo. I can hear a little bit of an echo. So I guess, can somebody check?
Is this better?
Is this okay now? Yeah. Yeah. Sorry, Inga, I think I'll have to.
While we are working on the technical glitches, Shankar, you good again?
Yeah. I'm good now. Okay, thank you. So welcome to the second knowledge sharing event of ESG Risk AI. The first one was held in late March and received a very positive response. And I'm sure that today's session too will be able to bring out quite a few new insights relevant to the Indian capital markets. This event marks the World Environment Day, which was celebrated last Saturday, June 5th. Equity Ratings is a full-service credit rating agency with registration from SEBI and accreditation from RBI. Equity is promoted by SIDBI, Dun & Bradstreet, and other large Indian banks. We have assigned credit ratings to more than 8,500 entities across 200 plus industries for their bank loans and bond issuances. Equity is also the promoter of SMERA, world's first rating provider dedicated to SME sector, and ESG Risk AI, India's first ESG rating company. Equity Group aims to be a provider of high quality ratings and grading services to Indian lenders and investors, and companies of comprises of these 3 entities. With business ethics, governance, and social and environmental footprint of corporates taking the center stage, we felt ESG assessment of Indian companies is a gap that we would like to fill up in India. While the ESG assessments are mainstream in North America, Europe, and even Japan, it is yet to gain significant traction in the Indian market. While ESG assessments on some Indian companies are available from international assessors, their coverage of the Indian market is very limited. Moreover, it requires a deep understanding of India-specific regulations and key issues for a comprehensive assessment of ESG risk to be able to provide actionable intelligence. When we started with assessing the Indian companies, we found out three major challenges: data availability, standardization of the data, and cleaning up the available information from a lot of noise that was there in the media. We created a model, consulted with market participants, and made relevant updates to the model as per feedback received from the market. Then we started tracking top 500 listed companies based on the market capitalization in terms of the information and disclosures pertaining to ESG, and started making the ESG assessment reports. We are now ready with 500 ESG assessments. They are ready for consumption. We will use the subscriber pays revenue model, where anyone who wishes to get access to the reports can subscribe to the reports and build their own portfolio within the subscription model. We are planning to increase our coverage to top 1,000 listed companies and probably by end of this year. And by next year, we are planning to start rating companies outside of India. There are aspiring private limited companies as well who want to assess their ESG performance. And we have developed rating models specifically customized to privately held companies as well. Recently, the State of India's Environment Report 2021 revealed that India's rank slipped by 2 places to 117 on the 17 Sustainable Development Goals, adopted by United Nations as part of the 2030 agenda. With less than a decade left to achieve global goals ranging from climate change, gender equality, inequality, to achieving sustainable cities and communities, stakeholders like government, regulators, investors, financial institutions, and corporates will play an important role in executing sustainability commitments. With targets like carbon neutrality by 2050, where India is the third largest emitter and the presidency of G20 just around the corner, India needs to pick up space and create suitable conditions where all actors can play their role and jointly strive in embedding responsible and sustainable business practices. Now, without spending much more time, let me invite our guest speaker, Mr. Robert Patalano, who is the acting head of Financial Markets Division of OECD, to give the inaugural speech. Let me introduce him. As I said, he is the acting head of Financial Markets Division of OECD. He directs a team of economists and policy analysts that develop analytical reports and policy recommendations for the OECD Committee on Financial Markets. Through various bodies, Robert oversees structural analysis and policy development with respect to global financial markets, sovereign debt markets, digital finance, infrastructure, and sustainable finance, including ESG and climate transitions. Prior to joining OECD, he was associated with Financial Stability Board, Federal Reserve Bank of New York, and European Central Bank. Welcome, Robert. The mic, I am handing over the mic to you.
And thank you, Shankar. I very much appreciate the warm introduction. So let me say good afternoon, dear esteemed panelists and participants from the public and private sector. What a pleasure it is for me to join this conference here in India Even if virtually, I wish I could be there in person. And I warmly thank the organizers at ESG Risk AI for the invitation and their courtesy and collaboration on this. It's really an important issue, sustainable finance, and of course, how to make ESG practices best serve investors and societal well-being. So in this regard, sustainable finance, development, and SDGs, as I'm sure many of you know, are really at the core of OECD's agenda, even more so as we confront the challenges posed by climate change and the COVID-19 crisis. So in light of our common interest, I'm delighted to provide this inaugural speech about both the progress that's been made, which is very important, but equally some of the challenges and how to overcome those challenges at a global level and at a country level. Let me give a bit of background as to how we got to where we are. So over the past few years, forms of ESG investing have grown exponentially in terms of assets under management. And by recent count, it's 40 trillion of assets under management that in some form or another are utilizing ESG. And it's now really embedded in the processes of the majority of the largest institutional investors around the world, both on the private sector side and even on the public sector side, where central banks and others are trying to integrate ESG into at least some parts of their activities. And this is all welcome. And moreover, the progress on ESG received a boost from the public sector. I think that you'll see too from the FSB, which gave birth to the Task Force on Climate-Related Financial Disclosures, the TCFD, which is an element of the E of ESG, and likewise the Network of the Greening of the Financial System, which has actually given more information about how ESG can be utilized for central banks' portfolio management. And in parallel at the OECD, substantial progress was made in several areas on climate in terms of the impact of physical risk and opportunities from growth of transitions to low carbon economies, for multinational businesses. And I think this is very relevant here in terms of how they use due diligence processes to take into account environmental, social, and governance factors into everything they do in terms of their supply chain and their operations, and even pensions and infrastructure practices where policies have been uplifted with ESG frameworks to ensure alignment with sustainability. So undoubtedly, there have been important efforts that have contributed to unlocking of an unprecedented amount of information to a range of investors and other stakeholders that can, at least in principle, empower them to better align value with values. And for a world that's grappling with these extraordinary challenges with environment, with pandemics, this additional information and the pressing need to address societal challenges and sustainability challenges is absolutely welcome. And if nothing else, it really helps us all think more about how finance and how business can help support SDGs in their pursuit of long-term enterprise value. So amid this crescendo of progress, the OECD's Directorate of Finance and Enterprise Affairs took a deep breath and said, why don't we just take stock of where we are and think about the quality and the integrity amid this rapid evolution. So we asked ourselves some fundamental questions such as, what is the purpose of ESG? Who does it serve? And is it delivering on the expectations of those it serves? Because this is the fundamental, trust and integrity is fundamental to financial systems and well-functioning financial markets, as of course, the Indian market regulators well know. And as a result, we looked at the evidence to try to understand where we were. And after a lot of evidence, and I will show you on a few slides in a moment, we came to a few high-level points, which is ESG has different meanings and the uses based on the needs of stakeholders varies, of course. A responsible investor may be looking at long-term enterprise value. There are the other types of investors that are looking at clear alignment with sustainability goals. And various ESG practices, from reporting to rating to investment approaches, have increasingly sought to serve the needs of multiple stakeholders. And first, in practice, it seems to have hindered the consistency, comparability, and alignment with financial materiality. And then second, it struggles to neatly align with environmental and social materiality due to the growing density of disparate metrics that are combined. And this is particularly true for climate transition risks. And of course, that calls for solutions, and I think that's why we're all here. So now if the organizers will permit me, I just want to show a few slides to show you a few charts to provide a bit of a hybrid keynote address, if I can do that. Do I have the ability to share the screen now? I do, let's see.
Yes, please go ahead.
Okay. Can everyone see the slides?
Yes, we can.
Okay, so in terms of the progress of the depth, we're showing that the ESG market coverage has grown significantly. It's growing in different pace, at a different pace in different parts of the world. But on the right-hand side, you can see for countries and regions, the penetration of publicly listed companies in terms of market capitalization is now quite high, which means that any regulation applied to large capitalized companies is going to have positive effects. So this is good. However, in terms of the current state of ESG, what we're seeing and other bodies are seeing is, in terms of methodologies, it's wonderful to have very different methodologies with different providers. It provides for price discovery. Nevertheless, the ESG rating by different rating providers obviously can cause a bit of discontinuity in terms of a lack of correlation of these ratings and what they mean in practice. And then on the right-hand side, you can see the chart that shows for those investors or central banks who may want to use the ESG for the E-pillar score, well, that correlation varies as well. So for some ESG ratings providers, the E is really an important component of ESG, and it may even be driving the ESG score. And that in concept could help with greening of the financial system. Whereas for other providers, the alignment with climate transition is a low part of E, and the E doesn't correlate well with the broader ESG score, which means it may not be as effective. So our point is that the investor really needs to understand what they're getting out of the ESG score and whether it aligns with their own objectives and portfolio needs. The second issue we thought to discover is, how has ESG performed over the past decade? Given that there are a lot of growing pains, it's grown phenomenally, and in concept, it's wonderful to unlock this value, but within these growing pains, there are a lot of different metrics. And as a result of that, that may not fully express financial materiality and long-term value, which is part of the story. And what we're finding here, as you can see, is that higher E rating scored companies and lower E rating scored companies may have similar returns and risk-adjusted returns. So there isn't, as of yet, a clear return benefit. Now, that's because we think it's work in progress. And as we all work together to really make sure these metrics are clear and standardized, where I know there's progress being made in India, over time, we would imagine that this story will clear itself up with the right progress with policies and regulation and everyone working on the same page. And then if you think about this for climate transition, a key question for central banks, for instance, if they're using the E of ESG to align with climate transition and with reducing the carbon footprint of their portfolio, again, it depends on the type of provider, the type of methodology. For some providers, higher ESG scores and higher E scores are associated with a higher carbon footprint. And that we found quite surprising because that seems counterintuitive. And we found no relationship or a low relationship with the E score and with carbon intensity. So that too, the users of the ESG need to be really clear how they're using the ESG score, how they're using the E score to make sure it aligns with their actual needs. What we did find in terms of climate transition, and I'm focusing on this because it's a focus of the G20 this year, in terms of climate transition, forward-looking metrics that can better capture, emissions reductions pathways, environmental innovation, green innovations. Well, we found that for major ratings providers that the E-score captures this a bit better. This is encouraging for those folks who want to invest into the transition to have an impact. But what we mentioned is this means that the infrastructure around the ESG in terms of assessment and verification is currently not yet in place, nor is it part of regulation in most jurisdictions to ensure that these promises, the forward-looking metrics, are meaningful, are tracked, and there's some mechanism to reward or to punish firms that hit or miss their promises in these climate transition plans. So then lastly here, I would say in terms of the issues and policy implications, there's a need for ESG mapping to better align financial materiality and environmental and social factors. We need to have a global set of core metrics for E, S, and G, and particularly for E disclosure, since the climate issues are really pressing. I would argue for the S as well, given the challenges with the pandemic. We need transparency of weightings so that at least the key parts of methodologies are understood by market participants and stakeholders. We need to have the verification mechanisms, which I just mentioned. And lastly, where investors and portfolio managers are saying, look, we're going to invest in low ESG firms. That's part of our strategy, but we're going to be engaging with them to help bring their ESG scores up. Well, that's fine, but then you need to have a real plan with boards and how they're engaging on climate transition plans or social plans to make sure that they're actually taking effect and making progress. So those are the key issues that I wanted to raise for my presentation. And I will turn on to, hopefully the presentation, you do not see it anymore, is that correct? Good. Okay, so I will just wrap, I will make some final points here about since I've been asked to talk about where we're heading on the global scene. And I would say this is really an important year for ESG and for climate. The OECD is moving forward with ESG risk principles policy framework to make sure that we'll have a high level guidance on ESG recommendations globally, on climate financial definitions, on risk principles, and climate due diligence for businesses. And NGFS, I think many of you are aware of the Network for the Greening of the Financial System. They're launching a new market transparency workstream to focus on these very issues, and the OECD is happy to be co-chairing that. The FSB itself is moving forward on a comprehensive multi-year roadmap on climate and finance to fill in data gaps and to get the metrics right. And third, the G20 Sustainable Finance Working Group is moving forward this month even to discuss how to make progress and improve ESG practices, including OECD considerations for strengthening climate-related metrics with ESG and with the E of ESG to align with net zero pathways. And fourth, IOSCO is progressing on its work with market regulators, including SEBI, to make progress on ESG on disclosure and ratings processes. And collectively, many of these efforts will flow in to contributing to steps that are being put forward by the IFRS to develop global minimum standards for sustainability-related financial disclosure. So these are all important initiatives that together at a global level, and of course, with support from national authorities, are making progress to make ESG really, really meaningful for society, for investors, and to make sure that finance aligns with sustainability goals. Lastly, let me just turn now to India. I am far from a specialist on Indian financial institutions and regulations. However, I have had the pleasure of engaging with the Indian Central Bank and market regulator SEBI while at my time at the Financial Stability Board. And for those experiences, I very much admire the thoughtfulness and thoroughness through which authorities are giving careful attention to risks and benefits in the system, and including now with sustainable finance. And I'm pleased to see that I had just an initial review, but I'm pleased to see that SEBI has extended corporate ESG disclosure requirements known as the Business Responsibility and Sustainability Reporting, which seeks to ensure that investors have access to standardized disclosures on ESG parameters. And this is really in line with OECD's own perspective on ESG recommendations for the G20, so I commend you for that. And the guidelines will be mandatory for the top 1,000 listed companies. And that aligns with the prior point that I made, that with this penetration with market capitalization, it really sets a wonderful standard when you're dealing with so many capitalized firms. It even sets the right standard for SMEs to move forward. And I'm also pleased to learn that this report lays considerable emphasis on quantifiable metrics. That's critically important, which allows for easy measurement and comparability across companies, sectors, and time periods. And in this sense, greater focus on performance assessment of initiatives, targets, and results. And this could be financial performance, this could be performance against societal values, but it should be clear, quantifiable, rigorous, and have integrity. And then I would say it provides interoperability of reporting, which is also important because there's so many different frameworks, and the fact that the system now, your system now is moving toward an interoperability with other forms of global frameworks is really an important step forward, and I commend you for those efforts. And as well, I wholeheartedly encourage the regulator, rating agencies, and participants to move forward and to assess the actual application of these standards, of the new principles in practice, to benefit from further refining them, to make sure they work, and continue that quest to make ESG really a fundamental part of markets, market integrity, trust in the system, so that the markets can do what they're meant to do. And at the final point, at the OECD, We look forward to sharing this journey with you and to build on this progress during India's G20 presidency in 2023, and we very much look forward to that. So let me conclude by thanking you all for your effort and commitment to strengthen ESG practices, which have the enormous untapped potential to contribute to sustainable, resilient, and inclusive financial growth. Thank you very much.
Thank you so much, Robert. This was a wonderful introduction to the global setting on what is happening, what OECD is doing, what all initiatives there are, and then slowly drilling down into what is happening in India. And we are happy to hear your comments on the developments. So very glad to see that OECD is in line with the developments that are happening in India and that we have you there to support the same. Now, picking up on the point that you have said that there should be rating agencies out there that look at the data, assess the data, see where there's data gaps, and apply ESG rating, try to make it more comparable. I would like to use this opportunity to share some findings of ESG Risk AI. At ESG Risk AI, we have done ESG assessment of 500 Indian companies, listed companies, and I want to share some of the results. Let me just go and share my screen with you. Can you all see my screen? I can't hear anything. Can somebody just give me a yes?
Not yet.
Not yet. Okay. Let me try this once more. Here you go. Now you should be able to see it. Perfect. So, as I said, at ESG Risk AI, we have collected and evaluated ESG data of 500 Indian listed companies across 64 industries. And I'm excited to share some of the observations from our ESG status in India. The presentation is divided in two sections. The first will focus on ESG assessments and insights from our top 500 listed companies. And then the second part moves to ESG rating reports and how ESG assessments can be used in decision making. So starting with the insights from the top 500 listed companies. Our ESG assessment reveals that companies' reporting is pretty decent. In fact, very well, considering that in India, the majority of disclosures have only been made mandatory recently. Also, it is important to note that this is data that we are sharing from 2019-2020, when people just started picking up and disclosing on ESG. And we expect in 2020-2021 that that data will be considerably better and show, like in other countries, that there is a gradual improvement on ESG reporting. As such, we are happy to say that the perception that there are no disclosures in India can be dispelled. As you can see in the graph, the average transparency, that is disclosures, across 500 assessed companies is 57%. Apart from 5 companies, all the companies have a transparency between 40 to 90%. And looking at the distribution of companies by market cap being as of 31st March 2020, there is a trend where larger market cap companies are showing higher transparency, which you can see in the top right corner of the service sector graph, 70 to 90%. However, when you look at the center, the cluster at the center indicates that transparency, other than that at the extremes, is not linked to market cap. Among smaller and larger market cap companies, there are those that report well and those that are not reporting well. And they really range from disclosures from 35% to 80%. So against expectations, a market cap is not as likely to have a good or a bad influence on transparency, meaning disclosures of the disclosures that a company makes. Looking at the different sectors, we have the manufacturing sector and the service sector. Reporting is slightly better among the service sector with 61% compared to 54% for the manufacturing sector. And large market cap service sector companies have the highest transparency scores. Again, the top right corner, 80 to 90%. While manufacturing company disclosures are generally slightly less, with the upper band being at 68 to 78%, and lower band starting with disclosures of as little at 30%. What does this mean? The large chunk of companies, especially those clustered below and around 50% transparency, which are smaller and large market cap among the 500 top listed companies in India. There is definitely room for improvement, and we are very excited to see what the new data of the next annual disclosures will bring. Here we are looking at transparency across industries. As I mentioned, we have covered 64 industries, and the average transparency across those industries is 57%. All industries are uniformly disclosing and reporting, and there is no leaders and laggards, which enables rating to be reliable across all industries. And there are opportunities for enriching data sets through regulations like BRSR, just mentioned by Robert, specifically on the numerical disclosures. Besides companies' reported numbers, data sets can be also further enriched through estimation models, which we are planning to integrate in our model in the last quarter of the year. This will allow us to fill reporting gaps by running estimates on, for instance, fossil fuels versus renewables, water, greenhouse gas emission reduction, etc. And this all becomes especially important in line with the European Union's Sustainable Finance Disclosure Regulation mentioned by Robert that came into effect on March 10 and focuses on consistency, comparability, and harmonized rules. Looking into the sectors, this heat map shows the number of companies by the National Industrial Classification Code, the NIC. The reason we are using NIC classification is simple. Each company discloses their applicable NIC codes and the respective revenue share in their annual reports. And and we take the NIC code with the highest revenue share. Subsequently, there is no interpretation from our side in terms of what industry the company belongs to. And coming back to the graph, the heat map shows that our data provides our clients with a full landscape and a fairly large population for comprehensive benchmarking and data comparison. This is just the start. As Shankar mentioned earlier in his welcome speech, we are today covering 500 listed companies. We are planning to increase this to 1,000 by next year. And we are also starting to rate unlisted companies, which further expands our database. And equally, the rating of international companies will commence in due course. Now let us move from transparency and add some flavor. Zooming into the environmental performance of the companies, it can be seen that industries that are large emitters or water consumers have comparatively poor risk management frameworks. This shows a clear disconnect between risk incidence and risk management. Taking the example of CO2 emissions, the performance score on emissions risk management is poorer for those emitting as opposed to those that are not emitting, which you can see, for instance, in power, emitter, and IT, not emitting. Risk management frameworks in companies with higher emissions like power seem to be lagging, while companies in the IT sector, though not emitting, proactively address the subject of emissions. Let's look at how we arrive at the risk management performance score. It is a function of two things, one being materiality, and then variables like strategy, initiatives, targets, and results. The low materiality in the case of the IT sector, coupled with the high number of initiatives on emission risk management, results in the high score on emission risk management performance. On the other hand, the power sector seems to be lagging in recognizing the relevance of the risk, the high materiality it has, and has room for more coherent strategies and initiatives. Our assessment shows that for now, the direction is counterintuitive. Companies exposed to higher risks have comparatively lower risk managements. And this would indicate that especially those posing high risks really need to start acting. Then moving into the social sphere. Here we have our assessments show us the need to measure community support and not just CSR spending. CSR spending is in fact just one aspect of the community support, but it does not end there. Companies have to have a community support and development framework in place to effectively support communities. Similar to the risk management performance score on the earlier slide, the community development support score is a function of policies, initiatives, including investment in different areas, as well as other non-monetary activities. While some focus strongly on CSR spending, like the paper and the pharma industry, as you can see in the graph, their community development score is just at par or even below that of others who are spending less, like construction, rubber, and plastic, as well as the power sector, since the latter have holistic community support frameworks in place. The message is really that at the same as in the earlier slide, companies need to focus on establishing comprehensive risk management frameworks to ensure efficient risk management and to have sustainable impact. And when we look in the area of governance, we wanted to cover all three categories. When comparing performance of public and private sector banks, our data shows that private sector banks lead board diversity with 66%. And generally, there's room for improving board diversity across all three types: the public sector banks, private sector banks, and non-banking finance companies. Now let us move to the second part of the presentation, using ESG assessments in decision-making. The ESG actor landscape, as Robert has mentioned, is a very wide one with different actors and different roles. We play our roles through ESG assessments and by awarding ESG leaders for their contributions to sustainable development. Our ESG assessments inform decision-making of all the actors. Let's see how our ESG data can help investors, cooperatives, asset managers, regulators and governments, financial institutions, and customers. So the table shows you an overview on the use case and the actor respectively. The depth of the data is what enables multiple use cases. There's a number of use cases that our data and analytics can support stakeholders with. And let me go through them one by one. One being portfolio selection and management. ESG assessments help you identify ESG leaders and laggards as part of your portfolio. Another way to use ESG reports is for active investments through peer benchmarking, or by identifying who is leading on a theme and pick out the investment accordingly. Equally, our ESG data allows you to gauge the level of compliance, or last but not least, since risk and companies evolve, we are continuously tracking the risks and the company's management of those risks, their performance. This also includes tracking controversies. This just gives you an overview on where you can use ESG reports and assessments. And since there is a continuous development in the ESG sphere, companies are picking up new tools and mechanisms on a regular basis. Our taxonomy is able to look at how the company is looking at upcoming issues. So data points that will come into the picture, especially those that are revenue generating, are, for instance, in the environment, the EPR, the extended producer responsibility, which looks at reusing waste of consumers, or clean development mechanism projects like zero waste, clean production. On the social front, you have FDA approvals, you have no GMO products, compliance with general data protection regulations. At the governance side, you have examples like Committee for Sustainable Issues that help identify ESG risk mechanisms to manage those indirectly, ensuring that cost savings are ensured. And it also plays a key role in ensuring good business practices and business ethics within a company. As such, we are able to highlight ESG opportunities and leaders that are able to monetize such opportunities, and thereby helping them and you to find companies that are preparing for the future. Before I end, I just wanted to, as a last thing, show you an example of what an ESG rating report looks like. And we have the ESG reports at ESG Risk AI have 6 sections: executive summary, governance section, environment section, social section, leaderboard, and controversies are those. And let us have a look at some of the extracts, mostly taken from the report from a leading oil and gas company. It's a mix and match a little. So here we have what you would see in the executive summary, which is an overall ESG performance overview. You have the ESG score, you have BRR score and transparency score, both being a transparency score on what kind of disclosures are available. You have the proportions of the E, S, and G. You have the rating of the company within its industry and within the overall universe. And there is a table which gives you, which is a benchmarking table, which gives an overview on the assessed company versus the performance of other companies, their peers within the industry on environmental score, social score, governance score, their rating, and the transparency score. There's a compliance and transparency section, which is there for the E, S, and G. And this one shows you how much the company is compliant with certain regulations like GRI guidelines and BR guidelines, and how many compliances they are having under those. It also gives account on the disclosures that positively and that negatively impact the rating, which is always interesting to see. On the left in the graphic, you can see that usually the positive, the indicators positively impacting the rating are happily reported, whereby those negatively impacting are lesser in number. And depending from company to company, you can see the blue line being the actual disclosures of this company, and the green line being the average of the industry. So depending from company to company, they are lesser or more. Then we have a leaderboard, which shows you the position of the assessed company among the peers. In this case, it's in the 4th quartile, and it also gives you account on all the peers within each of the quartiles. And last but not least, we monitor controversies, and we rank them by impact, very high to low impact, and we indicate in which of the 3 categories, environment, social, or governance, those negative news or controversies affect the score of the company. Now, I trust you have gained some new insights on ESG performance among Indian companies and the relevance of ESG assessments and reporting. What we will do, we will answer questions post the panel in case there are any. And we also do answer them during the event in this chat box directly. I believe I'm back on the screen, right? My sharing has stopped. Good. So, and then I really don't want to make you wait for the long-awaited panel discussion, and also not make our eminent speakers wait any longer. So let me introduce my colleague who will be moderating the panel, Mr. Suman Chaudhry. He is the Chief Analytical Officer of Equity Ratings Research Limited. He has more than 24 years of leadership experience in credit rating, credit research, and credit risk management. And with a diverse and rich exposure to the corporate and infrastructure sector, finance sector, and structured finance rating, Suman is passionate about building through leadership capabilities. So Suman, I'll hand the floor to you.
Thank you. Thank you so much. Good afternoon and a warm welcome to all of you, and especially the panel discussion members. Hope you and your family members are safe, and hopefully we will soon see some better times ahead. I am Suman Chaudhry, Chief Analytical Officer at Equity Ratings and Research. As Shankar mentioned, Acuité has established itself as a credible rating agency in the country, and over the last decade, and we have already completed around 8,700 ratings. Today, our panel topic is channelizing investment and facilitating responsible business practices. Honestly, I am not an ESG expert myself, but here we have a very esteemed panel who have been actively working in the ESG domain. Let me start by giving a brief introduction to the panelists. Our first panelist is Ms. Surabhi Gupta. With over 19 years of work experience in SEBI, Surabhi is currently the General Manager in Corporate Finance Department of SEBI. Ms. Gupta has been representing India in the International Organization of Securities Commission, IOSCO as it is called, IOSCO Supervisory College of Rating Agencies. She is also part of the working group between India and UK on ESG related issues. Our second panelist is Ms. Ruby Ojha. She is a Senior Environmental and Social Development Specialist in International Finance Corporation or IFC. With over 20 years of work experience, Ruby has worked extensively on assessing environmental and social risk and designing mitigation measures compliant with IFC performance standards. Prior to working at IFC, Ruby has worked in the E&S consulting sector and has carried out environmental and social impact assessments, due diligence, and compliance monitoring for various mega projects. Our third panelist is Mr. Sharup Mahanti, Chief Executive Officer of Mirai Asset Investment Managers. With over 2 decades of experience in the financial services industry, Mr. Mahanti is a strong proponent of ESG practices. In the past, he also worked with Religare Asset Management, Birla Sun Life Asset Management, and Kotak Mahindra Asset Management Company. Our fourth panelist is Ms. Somia Rajan. She is the founder of Waterfield Advisors, India's largest independent multifamily office and wealth advisory company. She brings over 25 years of financial services experience. Her last assignment was as Managing Director and Head Private Bank at Standard Chartered India. Recognized among India's top 100 women in finance, Somia has advised several of India's leading business families on their global investments, corporate and family governance, business strategy, and philanthropy. So welcome to all the panelists. But before we start, I want to bring the attention to our participants to the chat box. If you have any questions, please do send them in the chat box. We will try to answer as many as possible at the end of the session. So let me first turn to Ms. Surabhi. Surabhi, SEBI has been one of the early adopters of sustainability reporting among global peers. And if I'm right, the BRR disclosures for ESG was first introduced in listed companies in 2012. So my question is, how is SEBI ensuring responsible business practices and sustainable finance in India? You may highlight some of the key initiatives and particularly the benefits on investments that can accrue from this. Yes, sir.
Yeah, so basically, you're right in saying that we are the early adopters of ESG reporting.
Right.
Currently also, while globally, regulators are typically following compliant explain basis approach, we are following a mandatory approach. Recently, much of it has been talked about. We have come with our new format of sustainability reporting, which is called the Sustainability and Responsible Reporting, BRSR.
Right.
Basically, it's a notable departure from an earlier BRR, and it's more of a push from investors that has forced us to make these changes. Now, increasingly, we are seeing investors want to invest in a business which is more responsible and sustainable towards the environment. So as per our global peers, even we are pushing towards good ESG related disclosures.
Right.
I would like to, in this regard, I would like to just tell you briefly what kind of disclosures we have incorporated in our BRS. We have It's a notable shift from earlier BRR. While BRR was mostly qualitative, we have tried to make it more granular, quantifiable, comparable, and standardized disclosures. So the main thing that Robert and Enga had also highlighted about the risks and strategies and opportunities. So here, first thing that we have insisted on is that company has to give an overview of the material ESG risk and opportunities, that way they can mitigate it and its impact on its financial performance. This is a major thing that we have done. We have incorporated disclosures on sustainability related goals and the performance. Huge quantifiable data and metrics is insisted on environment related aspects, like you have to give the GHG emissions, the energy consumption, water consumption, waste management, everything. In social parameters also, we have again made it more granular and enhanced, where we have added gender diversity, social diversity, trainings on occupational hazards, welfare measures.
Right.
Communities also we have enhanced. We've asked them to give their disclosures on social impact assessments, rehabilitation of communities, local communities. So there are a host lot of changes that we have made. We have tried to make it more relevant. We have also seen the good practices that are prevalent overseas. We have gone into looking at GRI, the SAS, the IRC, everything, and we have tried to incorporate it here. So it is more measurable and comparable, and will help investors in making an informed decision, is what we believe.
Right. Great. And you believe that this will actually help in flow of investments, over the longer term, this enhanced disclosures?
Yeah, definitely, because as I told you, investors want to invest in companies. They want the business to be more responsible, and they want to invest in such companies only. So better disclosures would lead into better investment making by the investors. Even corporates would benefit it. First of all, obviously, it will instill some kind of a proper responsible business conduct, I think.
Correct.
As Indians, we are a bit lacking on this side. So more disclosures would make corporates more responsible. They would be able to engage with their stakeholders beyond financials also, because basically, while as far as financial reporting are concerned, we are far ahead, but as far as non-financial reporting or sustainability reporting is concerned, much of it was needed, and we have tried to bring it at par with financial reporting. So I think the company would be able to engage more with their investors with such kind of disclosures. It will instill confidence in investors, and obviously it will result into a longer value creation for the company. Investors are looking for more of such disclosures.
Right.
And the investors have also understood that climate related parameters actually affect the performance of the company and therefore impacts the financial performance. They want such kind of information. So it will be beneficial to both the investors and the corporates.
Absolutely. Okay, next, let me go to Ruby. Ruby, IFC has always been at the forefront of responsible investing globally. How does IFC incorporate environmental, social, and governance risk management into their investing or in lending approach? And why do you think such assessments are very relevant, not just for IFC, but for all investors?
Sure, thanks for this question. I think, from what I've heard in the previous sessions and what Surbi was saying, this is a well-established fact that ESG risk assessment is very integral. And, when I speak from the point of view of IFC, it is very integral to all our investments. And we continue to monitor and handhold our clients, not just at the time when we are making the investment, but throughout the lifetime. So the way it works is that IFC has an in-house team of ENS specialists who carry out the ENS appraisal when we are reviewing any investment opportunity. The idea is that we assess whether the project is compliant with what we have called as the IFC performance standards. These are the international ESG standards. And there are times when IFC would also hire third-party consultants. Like today's times, COVID times, when IFC staff is restricted to travel, or there are times when IFC would advise the client to get ESG assessments done. And these ESG assessments could be of different types, like an environmental and a social impact assessment, depending on the type of the industry. So it could be labor assessment or anything. Based on this kind of review, IFC generates a document called as the ENS review summary, and also chalks out an ENS action plan for closing out the gaps that we would have identified. IFC also has an access to information policy, and based on that, we make a disclosure of this document on our website. Now, one would think that IFC's role would end at this, but that's not the case, because we continue to engage throughout the duration of the investment. So IFC would visit the projects. We physically go to the projects that we have invested in. And we also review what is called as the annual environmental and social performance reports submitted by the clients. And based on this, we assign, I'm coming back to the topic that is of discussion, the ENS risk rating. So the ENS risk rating is assigned, which ranges from 1 to 4, with 4 being unsatisfactory and 1 being excellent. And this risk ratings are again dependent on several performance factors. It could be related to what is the organizational capacity within the company for ENS, what are the ENS management systems being implemented, what is the compliance with host country regulations, etc. And dependent on this kind of rating, IFC then takes a decision on whether IFC is keen to do a repeat investment with the same client, or whether IFC would like to work on an action plan with the client. So that's how we integrate it in our investment. I hope this answers your question.
Yeah, I think that's a very interesting point that you made, that there is a kind of an impact assessment or a review of the investment and how that alignment on ENS is happening. So I think that's very, very interesting. I will now turn to Swaroop. Swaroop, it's estimated that around $40 trillion has already been invested globally based on ESG principles. While in India, it is still, ESG investing is still in a nascent stage. There are already 10 ESG focused funds which have been launched. Out of that, 6 has been launched recently in FY21 itself. Now, being a global asset manager, how do you think ESG affects your business globally and in India? And what is this the ESG strategy that Mirai has for India?
Yeah, Suman, thank you for the question. I think it's very relevant from an ESG perspective in India. When you look at the last decade or so, we've seen growing voices from across the globe where asset managers are required to incorporate ESG or in some form or the other in their investment processes. Along with that, the institutional investors are increasingly recognizing the potential for ESG factors, such as, say, the climate risk, poor human rights performance, or privacy, etc., to affect the valuation and the financial performance of the companies they invest in. At the same time, there is a consumer demand for responsible investing, and that is surging, especially from the millennial generation. You just heard that the regulation is also emerging. For example, in India, the regulator has come up with implementing ESG disclosures to the top 1,000 companies. Now, Ms. Gupta just elaborated that the companies will need to provide an overview material of their environmental, social, and governance risks and approach to mitigate or reduce the risk along with their financial sort of implications. The interest has also increased across board, and more studies, as we start getting deeper into the subject, more studies are now pointing to the fact that ESG investing does not lead to performance penalty, which was a thought earlier. And on the contrary, ESG-based funds have outperformed both from a return and return to risk point of view. There is no surprise, I feel, to that, and that's why we are very strong proponents of ESG, that any company or any person for that matter who focuses on, say, people, planet, and profits and has a robust business practice will have a sustainable glide path towards future growth. And that is why, you've seen that kind of money coming into asset management. From Mirai perspective, we manage close to $1.5 billion in ETFs across our globe. mostly from Canada, Korea, and the United States. Here in India, we recently launched an ETF that tracks the Nifty 100 sector leaders index, and we prefer to keep it on the passive side. When you look at the broad aspect as a global asset manager, we are very cognizant of the challenges that also are associated with ESG, and this will develop over a period of time because a complex landscape of ESG is also a big challenge. There are different expectations from institutional investors, the likelihood of new regulations, and that's something which will evolve, and current uncertainty of the in its present form is something which is playing on everybody's mind. An absence of a standard ESG term or a metrics of reporting format at the beginning stage is something which is there in India. As a result of which, especially in India, ESG will also require a lot of education from asset managers. That's our view. And we believe in this theme, and I think it may get wider adoption in India sooner than we expect. Because as the story unfolds today, even PSU companies are already working to incorporate ESG practices. Several large companies are taking the lead and have taken to ESG reporting already. And push from the regulator is already there, and even from the government of India. So our strategy is very simple. Our strategy is to provide investors an option of investing in a set of Indian companies that score well in terms of their ESG management. For this, we've adopted the passive route. We are the first and the only AMC in India to provide an ESG theme based on the passive product. We need to understand that ESG data are by and large quantitative in nature, and adapting all that information requires a domain expertise, which is significantly different than simply evaluating companies based on financial parameters, which we have done till now. This is far beyond that. We believe in providing a true to the label framework based on ESG exposure to the investors. Hence, we believe that the ESG research providers are far superior at this moment than inherent, basic fund research that is available in its present form. It's a far bigger landscape than we can possibly apprehend. And then we have outsourced our basic research to an external research provider, and hence the passive form in its approach. On the active side, as it unfolds, we will start incorporating. And at this moment, ESG is very much restricted to the larger companies from our perspective. But as the research starts developing, and we are seeing the beginning of it today on this panel, we expect to expand our portfolio to the smaller companies too.
Absolutely. I think that's an interesting point that you said, that the awareness in the funds industry in India is coming earlier than expected. I remember 1 year back when we were doing a market study on ESG. Then we really came across some of the fund managers who felt that the product is still some distance away. It's still a little advanced for India. I think that scenario is changing rapidly, and probably.
Yeah, so I'll just take a minute on this one, on what you are reflecting. When I started reading ESG 2-3 years ago, I thought it was basically a theme. Today, I realized it's a core product to my portfolio, and that's just 2-3 years. And when it unfolds, I think a lot will be said in the future on this.
That's very important. That's very encouraging to hear. I will turn to Somia now. Somia, how do you see the adoption of ESG by HNI investors, including family trusts? And do you see corporate family-run businesses recognizing the importance of ESG?
Thank you, Suman. And I think great comments which have been there right through in the session so far. I'm just going to throw the lens a little bit on how domestic investors are just looking at this space. From where I sit, what I see is that while a lot of the heavy lifting has been done by regulators and by fund managers so far, very little has actually been done by the asset owners. And that's where I think is really where the playing field is going to shift a little in the next couple of years, where the asset owners have to start demanding a lot more in terms of ESG disclosures and otherwise. So, just coming back a little bit to Robert's point initially when he talked about why is ESG so important today? And I think when we had the pandemic, which is just, which was in some way still in, what we saw is that traditional forecasting models just completely fell apart. So for investors, you could not actually do a proper forecasting model. So necessarily going forward, as we see climate risk, as we see governance lapses, ESG in some ways is going to be able to help us in order to assess those risks going forward. So for a lot of domestic investors, one is just creating the awareness of why is this important. Otherwise, it just becomes another theme or another acronym which is out there that people don't understand. So for us, it's really to create that awareness in the first instance before we come to the adoption. And the awareness really sits because, as I said, on forecasting, you just cannot do complex, nonlinear, systemic kind of risks do not come into your regular models. The second part of it is around just families and family offices, and many of them are actually family businesses. Quite interestingly, family businesses actually, the ESG integration sits almost very naturally with them because everything for a family business is about longevity, is about taking the long view. What is ESG integration? It's taking the long view on sustainability. So when you look at companies which are really family-owned businesses, they are actually going to, in my estimate, going to take to ESG quite easily and naturally. Yes, there will be the complexities around disclosure, materiality, sectors that they sit in, and so forth. But fundamentally, their alignment is the sustainability of the business in the longer term as a family business. And therefore, ESG is going to help them in that entire approach. And if you were to look at just investors and family-owned businesses today, they've already had some kind of values-based investing that they've been doing in the past. So this in some ways is an extension of that. And how do they then integrate ESG and into their investment decision-making? Taking to your next question, which was more around corporates, and these same promoters have personal wealth, which they're trying to invest on those principles. And equally, they are the promoters and on the boards of companies that they run, through which other shareholders and stakeholders are looking at them. So what we see in our conversations with these families is typically twofold. One, a lot of them don't want to be penalized for having poor ESG metrics because they may get the governance right, but if they're in a sector which is sensitive or difficult to maneuver, they realize that for them it's going to be a roadmap, and the roadmap is going to be medium term. So in terms of the disclosures that they provide through the BRSR, and through the fact that they want to work towards how is it that people are going to assess the fact that they're going to be having better carbon, lower carbon emissions, or they're going to be managing their waste better, or the processes that they have in place. These are all going to be important, and families look at it and corporates look at it more from the lens of the medium term at this point. They don't think that they're going to be able to solve everything in a hurry, but the intent is that they're going to try and make that effort in order to try and get to that point where their ESG scores are reflective of the processes that they're actually demonstrating. The second point I want to make on corporates is really around boards, because at the end of the day today, we've just seen Infosys has just started an ESG committee, for instance. Now, the question that many companies and boards are asking is that where does ESG sit? I've got this BRSR, which is there. I've got the sustainability metrics, which I'm going to be looking, I have to disclose. The board oversight on that is going to be very important. So the question then is that, is the regulator going to say you need to have an ESG committee? We already have a CSR committee, which already has an independent director. The question will then be, should that morph into an ESG committee where CSR becomes just a subset of one of the things that they will look at? I think these are questions that companies are asking, which we need to kind of address. But clearly the shift is going to move, I think, and has to move to asset owners demanding that and holding the companies that they, the fund managers are investing into at a higher yardstick going forward.
Right. Excellent. I think your point on corporates, and there is always this perception that family-run businesses, Indian corporates, they are unlikely to see ESG as a serious matter. But I think what you said is very different. I think they are looking at it seriously, and so I will. So that's really very good to hear. So I will be back to Surabhi. Surabhi, again, in those same lines, do you foresee any major challenges in the adoption of these enhanced disclosures, BRSR disclosures?
Yeah, I would come to challenges. I want to first answer Somia with regard to oversight of the board. So
Sure.
BRSR, we have a
Please.
while we are not insisting on an oversight by the board currently, but we have asked some questions as to whether the oversight, do you have a committee on ESG, and the committee is at which level, board level, or is it at a lower level? And we have a specific a section made where the directors have to report on the ESG related risk opportunities and the performance, how they've performed. So as a kind of governance on board level is something that we have tried to build in. We'll see how the disclosures come. And with regard to challenges, yes, we know that once you come out with something, you also know the challenges that would come ahead. So we are actually preparing ourselves for
these are pretty extensive. Whatever the annexures that I looked at in your release, they are quite it will take some time, I think, for the corporates. So I just wanted to understand what's your view on how corporates should take it.
So while we know that it has been talked that BRSR is mandatory from next year and not from this year.
FY23.
We would encourage actually corporates to be early adapters and lead by example so that they inspire others also to take it. It's the investors, the market wants it. So we'll be happy to see some early adapters. As far as challenges are concerned, so we are largely going by disclosures. We are not mandating any third-party assurance, but there is a question asking on whether you have done any kind of third-party audit has been done or not. The company has to say yes or no. So greenwashing is the basic challenge, which is that will come up as the disclosures are coming. Probably in future, we'll have to see whether we should mandate some kind of third-party assurance and
auditor. Right.
Yeah. By that time, we'll have more of such auditors also. The other area that we need to look into is currently our format is sector agnostic. So it's open for everyone, and we have said that if it is not applicable to you, you say it is not applicable. Don't give the numbers, but you have to also mention as to why it is not applicable to you. So probably going in future, we'll have to make some sector-wise questionnaire the way
customized for sectors.
Yeah. And then obviously ESG mutual funds coming in, probably we'll have to go to see how, based on truth, is it actually truly ESG, going into truth and labeling. And obviously there is a lot of demand on ESG rating or ESG scores, data providers on that, so that investors can invest. So these are few challenges, or you can say work that we need to go on, and it will continue for some more time.
Right.
Someone, if I may just come in with a question for Surabhi, which is really on the BRSR, you've got both the essential indicators and leadership indicators that need to be disclosed. Are the ones which are more serious about this are going to hopefully do the leadership indicators as well? What's your sense of how the companies are going to react to this?
So basically, before coming out with BRSR, we had a roundtable with few big investors. We took a stock as to what is measurable and what is important, what is quantifiable and measurable immediately. So we try to keep all aspects which are measurable in essential category. Leadership is largely based on value chain partners, and which in future, so this is how it is segregated. In future, we would want all voluntary to be shifted to essential. So it's just kind of, we are looking forward to it. But again, we would encourage needs to actually adapt and report on leadership voluntary parameters also. This is what our ideal scenario is, which is what we would happy to see and encourage companies to do that.
Thank you.
Right. Right. Ruby, if I can ask you the another question, how can large global investors like IFC, they can encourage good quality ESG, transparency, and how to, make corporates take it seriously?
Sure. So I think as my fellow panelists have spoken quite elaborately about the transparency fact, and also in the previous presentations, one thing that we should recognize is that ESG transparency is a new concept that has recently started. And it's only in the last few years we see many companies now disclosing their sustainability reports, which is based on a GRI reporting. I mean, if we have to think why is ESG transparency important, I mean, people have spoken why it's important, but if I have to just think from the lens of an investor, it is actually providing a proactive communication with the stakeholders, and which results in a reduction of the project uncertainty. And lesser is the uncertainty, it does help in attracting investors and lenders. Lenders and investors are interested in investing in a project on which there is a clarity and there's not much of uncertainty. And ultimately, it creates something kind of value called as a sustainable value, which is much beyond the financial value. And I would like to just borrow this from Swaroop, the comment that he made, that people, planet, and profits go hand in hand. So I think that is a very remarkable comment that he made. Also, the ESG disclosure and how IFC would be using is that it would indirectly help in the capital flow in the emerging markets. Because when investors have access to this kind of information, which is accurate, which is comparable, instead of just the financial data, also on the ESG performance, which is very crucial. So IFC has published a document which is called Beyond the Balance Sheet, IFC Disclosure and Transparency Toolkit. So it's basically designed to fill gap between the companies and the investors around ESG practices and level the playing field, because right now there's a wide gap.
Right.
As of now, the ESG disclosure remains quite fragmented, as you would appreciate, and because it's voluntary, it's something that's not mandatory, and there's no standard practice. So this particular toolkit actually provides a detailed guidance on how to prepare integrated ESG reports, and it includes several examples from companies in both developed and developing market. And it provides quite a detailed guidance. As of now, there's no digital platform, but this is a work in progress. And the toolkit team is also working on developing a digital platform wherein companies and investors will be able to disclose and access the ESG information. So I hope this answers.
Okay. So this toolkit is in the public domain that you have published?
Yes.
Okay. I'm sure this will be a kind of a primer for many corporates who want to kind of induct the best practices. So Swaroop, how can a transparent and objective framework for ESG assessment help your investment choices? So a product like ESG assessment, the kind of products that are there, how helpful are they for this? Let's say if actively investing, how relevant are they?
See, finally, it boils down to say the ESG ratings which come about through this process. And when you look at the ESG ratings, they're basically designed to measure the company's resilience to relevant and material, say, environmental, social, and governance risk parameters, which the company is exposed to based on its business line, right? ESG ratings score help in sort of identifying industry leaders and laggards according to the exposure
Absolutely.
to ESG risk, something which Ruby referred to. And see, this is very objective. It brings out a particular score, so it brings out that transparency that is very much required. It also highlights the issues which are critical to concerned companies or sectors, enabling the asset manager or investor to take an informed call. For example, in our product, which we launched, we not only look at the ESG score and controversy score of a company, but also compare the ESG performance of that company with its global peers. Right? The companies, yes, we benchmark it to the global peers and form that relative scoring. The companies whose performance is below an average is excluded, and that is possible because there is a score, right? It's a fairly defined sort of score. This detailed information helps us create a superior portfolio from an ESG point of view. A framework-based ESG leaves no room for ambiguity, something which was very much highlighted by all the participants here, and provides much more comfort and clarity to the asset manager and subsequently to the investor. A rule-based ESG rating and selection of the portfolio based on the same means that the investor actually exactly knows what the fund will do, and more important, where it will invest, and more important, where it will not invest in, which are non-ESG and things like
transparency.
That.
Yes.
You know, this transparency and clarity adds to the appeal of the product by making it true to the label. And as this goes in the belief that the culmination of all these three factors, first of all, you cannot survive without taking these factors into existence. It's more survival than anything, is something which has to dawn into people. As Somia rightly said, it's a matter of time that the investors will start demanding it. Global investors are already demanding it. Countries which are susceptible to climate change are already up the curve in ESG investing. And all that adds to the whole thing. The only thing we thought when we build a product, that when you have an ESG kind of a framework and you leave it to active management, you leave it to the subjectivity of the fund manager. When you put it on the passive side, it is rule-based and makes it even more transparent and ruthless in its selection, is our thought in this entire process. But yes, it's based on the ESG rating framework, which brings out this transparency.
Right. Just one additional thing here. Is there a negative, like when such a rule-based system works, is there a negative list, like you don't invest if the ESG score or assessment is low, or there are certain sectors where you wouldn't invest? Is there any such rule as of now, or?
So the rule is not negative in that. There's another very interesting thing, because when I've talked about ESG to a lot of people feel it's an exclusion sort of thing. Well, actually ESG is inclusive in nature. You know, that's something which people have to understand, that everybody is included, and based on the industry line, there are parameters to the score.
Correct.
But what we do is we take the top 50 scores. So the top 50 which come to the score form the portfolio.
Got it. Okay.
Swaroop, I have a question.
Yes, ma'am.
Do you think you have a proper benchmark currently available for your ESG funds?
See, actually, since we made it rule-based and it tracks the top 100 companies, I'll give you both sides. First is it is restricted only to large companies. We believe at the nascent stage of ESG in India, and it's great that, finally rating is happening in India per se, and you are pursuing it at this level. We believe that, a lot of data will come voluntarily as the regulator starts pushing for it more and more. So at this moment, for the large companies to be, to survive both on borrowing as well as its position in the stock market or the capital markets, it's better to stick with the larger companies. So we've not yet gone into the smaller companies, and I am not in a position to answer that question at the moment. These questions will come only when we start getting into market companies below 150 in nature, which is entering the mid-cap zone. So we are playing it relatively safe at this moment, to be very honest. So we're sticking to the top 100, and out of that, we select the top 50.
Right. So one last question that I have for Somia. Somia, where do you think the market, that is the asset management market, is headed in terms of overall ESG adoption? And what role can ESG ratings play in making data comparable across geographies and industries?
I think for us, the biggest challenge right now is actually the data. So Waterfield, for instance, we signed up to the UNPRI. We were the first wealth management company in Asia to do so, which means that we have to integrate ESG in our investment decision-making. And when we started going about that whole process, what we found is that data for us is actually the biggest issue at this moment, because a little bit of what Swaroop alluded to was the coverage of companies right now. We're not seeing enough companies which are covered, and hopefully the BRSR, which has been mandated, will standardize the metrics through which we can access the data. I'm going to put out a slightly controversial statement here to say that within this ESG ratings, there are multiple companies that are doing that. And each one of them has in some ways a kind of black box in terms of the rating. So when you're sitting on the other side and you've got this rating, which you are then trying to figure out, is the E and the S and the G in each of these, there's one set of people who are saying one thing and another set of people saying another thing, all on the same metrics which may have been disclosed. That then leaves you on the other side trying to figure out who's right, who's wrong, who do you follow, who do you not follow. So my own sense is that at some point, it is still a black box for us sitting as an investor because we're dependent on that rating. And that rating is coming out through metrics and data which is collected otherwise. So that's one point I'll just kind of keep out there. The other, of course, is that in the ratings also, today they are backward looking. It's based on data that I've collected. It is not with a forward-looking lens. I think you, again, Robert, touched upon this early on, but the issue will be that if it's going to be forward-looking, how fast are you going to change or adjust that rating for a material disclosure, which has happened on any of these? So is it going to come to you 1 month later or 2 months later or 6 months later? Maybe too long, because the change has already happened in terms of the way in which you as an investor are trying to assess the risk sitting with that investment. So my own sense is that, I think great, it's a wonderful beginning. We desperately need it. Data is going to be the issue. How we trust that data is going to be an issue. And also the fact that, how forward-looking can this be, so that we are able to move and maneuver much more quickly as investors.
Right. Great.
Can I, Suman, can I say something on Somia? Because she said it is controversial. I don't think it is controversial at all. What she said is very important, because finally the rating is subjective in nature, and you have multiple rating organizations there. The risk of what rating is what needs to be also put out there. So I think it is the crux of the whole thing. When suppose we are outsourced to one rating agency, and that is the subjective knowledge that we get from that particular one. The risk that the parameters have to be somewhere similar in nature is something which I'd leave behind to Surbhi to keep in mind. And since we are at a beginning stage, a lot of these risks which have unfolded in the other markets can be mitigated at the beginning. Is a very, very important point which Sutapa is pointing out.
Absolutely.
Somia is pointing out, sorry.
Some kind of a consistency or standardization in the way the ratings are, different.
And I don't think it is controversial, Somia. Again, it is not controversial at all.
Thank you, sir.
So we are mindful of that. We have some committees also, and we are exploring this aspect also.
Okay. So I think with this, we will come to the end of the panel discussion. But I can already see that there are quite a lot of questions in the chat box. So without further delay, we can now turn to some of these questions that has been posted. Inga, would you like to join, and we can do this together?
Yes, sure. Let's share questions out. We've been trying to keep a track on the questions that were coming in, and quite a few have already been answered in the chat box, but we did keep some for everybody to get a question and have a chance to elaborate on our attendees' queries. So let me maybe start with somebody who's not now spoke on the panel, so that we give the panelists a short break to think and review. This question goes to Shankar. Environmental and social management process should be integrated with a credit and risk management system for all financial institutions, including private and government banks and NBFCs by country regulatory bodies like RBI and SEBI. ESG risk management should be given a substantial score in overall credit rating by the rating agencies also. Otherwise, ESG practices would not be successful in India. This is my view as a E&S manager of large number of infrastructure projects, finance and equipment finance. Request panelists' views on these points. So maybe Shankar can start and then the panelists can join it.
Yeah. So the reason why we got interested in ESG, quite some time back, even before ESG became a mainstream subject of discussion amongst investors, was because we saw quite a few credit failures back to back, starting with Antec Auto and then culminating ultimately into a DHFL default. And we, our analysis showed that the difference between a highly rated company and a defaulter essentially is the standards of governance. So that's where we started, and we really wanted to introspect in terms of the standard best practices that we are following. SEBI took a lot of initiatives in enhancing standards of credit rating, right from about a decade back when rating industry was under light touch regulation to last 3 years when after these incidents took place, when SEBI.
Shankar, I believe your voice, you have been muted.
Can you hear me?
Yes, now we can again. I think.
Yeah. So, what our experience has been is governance risk eventually translates into credit risk. We are part of a country where climate risk is going to cause havoc if they are left unchecked. We have a very large coastline. We have a lot of dependence on agriculture. The country is extremely highly populated. So any climate risk will result into displacement, and not just displacement within the country, but the most highly under risk country is Bangladesh. So you are surrounded by other countries which are also very populated. So these are factors which is not going to remain on a textbook or in terms of just some academic papers. They will actually translate into risks, financial risk. And today, most of the action on the ESG side is from the investors, but we firmly believe that the banks has to actually start looking at ESG risk very seriously. We have also already seen that one investment of the State Bank of India received a lot of attention because of an international sports event. Some of the people raised the issue there. So obviously ESG is going to impact credit risk, and therefore any credit risk model has to have an element of ESG assessment. However, what we have to be careful about is using ESG as a marketing tool for the rating agencies. I personally believe the rating agencies should refrain from doing too much of a marketing, just like lawyers or doctors. But there could be a tendency to jump into ESG just because anything associated with ESG can lead to more business. So this is something that we have to be conscious about, and that's why we have kept two companies separate. We have a separate unit doing bank and bond, bank loan and bond ratings. We have a different entity altogether looking at ESG rating. But the technology or the insights that we will develop will surely get passed on to the credit rating side, and some of these modeling data will all definitely be used in due course. There is a initiative of UNPRI in incorporating ESG standards in credit rating models. This initiative is probably a year old, And we are in talks with UNPRI. If we join that project, we'll be the first rating agency from India to join that project. There are a couple of rating agencies from US and Europe who have already participated. There are 10 or 15 investors who are part of that project, and we are in talks with them to start seeing. What is important is to build universal standards, and as Somia, you have mentioned, is that we also understand the risk of rating models and rating methodologies remaining a black box, and that's why we want this to be an industry level phenomena where ESG modeling gets used by the credit rating counterpart of ours, but not just with a lot of transparency. And though I am answering one particular question, but I think I will agree to to that statement of yours that this is actually not a very controversial statement to say that the rating models that we are using should be transparent and it should be forward looking. So we disclosed, we have already published, even before the ratings were published, we have already published our rating methodology. It's a fairly detailed report. You can, we'll send you a copy of that. You can see that. And as an investor, if you're looking to get in, more insights or more inside view of how we are doing the modeling, how we are collecting the data, what kind of taxonomy we are using, right down up to each of the weightages or materiality that has been assigned to 720 data points that we are collecting, we will be open to sharing of that to you as an investor. So we will strive to remain transparent and meet this particular expectation of yours, without which we will not be able to get success. Over to you, Inga.
I would want to give the question also to the panelists in case anybody would want to add. Yes, Ravi.
Actually, the question asked is also on incorporating ESG-related aspects in the credit and risk management of financial institutions and banks.
Correct.
So, RBI and SEBI, we both are on one committee where actually we are exploring, we are working towards financially resilient system, where we are working towards, we are seeing how much banks and financial institutions are integrating and taking into consideration the ESG parameters while extending loans or in their books. And accordingly, we are exploring of having separate set of disclosures for these financial institutions or lending institutions. So it's still a work in progress and it is at a very nascent stage. So let's see how it pans out.
Right. Inga, should we take the next question?
Sorry. Would you like to take the next question or should I pick one out?
Okay, let me just look at this.
While you look, I can maybe go with the next one and then I'll give the one after that to you. So this is a question for Sror. How is ESG score and rating integrated in the investment process and the impact it has had on the returns? Any working example would be very beneficial to have an overview, one of the attendees is asking.
Actually, since the ESG has just been incorporated for a year in India, it's too early to sort of come to any conclusions on India. But if you go to the advanced countries and mostly Europe, which is up the curve on ESG investing, which they term as sustainable investing, some call it responsible investing. We give this great opportunity to investors to marry their own personal values to investing. There, if you look at, and post-COVID, the data is becoming even more glaring. Almost 65% of funds on the ESG side are outperforming non-ESG. So that is where I said that, There is the earlier thought that ESG could be laggards, but that is not so. And it just shows that longer the horizon of investments, the longer the companies become sustainable, and companies which it's very simple. Companies which incorporate these three values and go beyond financials finally end up becoming more powerful and sustainable over a period of time. And hence, this is the outcome. Somia was referring to a lot of data being on the hindsight, but ESG is very forward thinking, and one has to believe that if these factors are incorporated by any company on a sustained basis, please understand, investing in India has been mostly on financials and taking into consideration a very small part of G till now. We have still not taken into consideration the E and S into our investing framework, where countries which have gone ahead of this have already incorporated that into their portfolio framework, and then the data is already there. You don't need to ask me, you can just Google this. This is very publicly available data of how sustainable investing is leading to better risk reward return for the investor.
Right. Inga, should I go ahead?
Yes, please.
Yeah, I think there is one. This looks like for Surabhi from the audience. It says BRSR is mandatory from the year 2022-23. Just for clarity, does it mean that the top 1,000 listed companies with their audited financials as on 23 will report BRSR, or BRSR will be reported alongside the audited financials of 22? Is it for 23 audited financials or 22 audited financials?
So for 21-22 financials, it's voluntary.
Right.
And you can still, we would be happy if you report it. Otherwise, it's mandatory for financial year 22-23. So September 23, you'll have to disclose.
Okay.
So
it is voluntary for 22. That is the answer to that.
But again, we'll encourage companies to disclose it.
Yeah. I think your press release also, your communication also says that.
Yeah.
Right. Okay. There is another question. This, of course, is also for you, and others also can respond to. So this is from somebody anonymous. But why Indian regulatory bodies like RBI and SEBI is not making ESG practice and ratings mandatory for industries and service sector? And should also ENS risk management practice be mandatory in India? It is voluntary, and that is why this practice has not reached its peak. That's the comment coming from.
So I think, yes, we are evolving. I won't say we are late starters, but yes, we are there. And our efforts are towards making it mandatory. And yes, we've made it mandatory. Now made it mandatory for top 1,000 companies. People will see good disclosures now coming out, and they'll see it being a main input for the investment decisions by the investors also.
Right.
So we're almost there.
Correct.
And it's more, it has to be more from the investor side also.
Absolutely. So it's being driven by investors at this point in time. Right. You're right.
Suman, there is a question for Robert. Does OECD have any plans for India going forward, or any inputs? I mean, now you heard a bit of a discussion on what's happening, so you elaborate.
I could certainly give you my ideal perspective. So we're really encouraged by the process that Indian authorities are making, and in a very thoughtful way. And this is just my personal view, but there has been a debate about sort of advanced countries. Many in the OECD are really on the cutting edge of the learning curve, and developing countries are having a challenge catching up. I don't think that's true. I think what I've heard today, and I've seen in some other countries, but particularly what I've heard today, really shows the innovative practices, the moving ahead to think about mandatory requirements, the analytical work that you've done here today is really phenomenal. And I think that India, particularly as it moves towards its G20 and thinks about the sustainable finance work that it wants to achieve in the G20, has an opportunity to be a leader, a shining light for other developing countries and even for advanced economies, to show what you can do when you put your analytical thinking and tools together and the right leadership. I think it's very impressive. And the OECD has a number of directorates looking at this from a market standpoint, from an ethical standpoint, even from an AI standpoint, you name it. And we're very happy to lend our own services and intellectual capabilities to help India during this process and to make your own G20 successful.
I also would like to add, Robert, because globally we are seeing a shift towards a common integrated framework. It's more of a TCFD, which is completely climate. Whereas we believe we have to be climate plus. Only climate will not survive. It has to be climate plus. It has to be social also, and largely social. So we are working towards that, and we'll happy to see if globally also we see that push, because currently the push is only on climate side. Right.
There's another question, Inga. So this, whoever would like to answer this, the asset owners and the investors are expected to push for the disclosures. But what about the financing of the fossil fuel industries essential for the economy? Sustainability comes to forefront, both in the long term, but in the short term for a country like India, how to look at it and what can be the approach? Anyone?
I think ministry is working towards it, and we have taken a political stand also on it, that we are heavily dependent on fossil fuel. But yes, we also have a very ambitious plan on shifting towards renewable energy, and our Prime Minister has already committed a lot and for renewables energy by 2030, 2050, and we are on the time plan. We're working towards it. So they'll see more renewables in 2030. We are shifting towards that. But we cannot completely do away with fossil fuel currently.
That's right. I mean, in India, the other day, I was just checking the data. Our domestic coal production is around almost, I think I was hearing the senior person from Coal India saying that the target is 1 billion tons. Currently, I think we are probably 800 million tons around domestic production. And additionally, we are importing a substantial amount of coal. So
yeah, and we are changing our technologies also. Now we have green coal, we have black coal. So things will evolve, I suppose.
Yes, I think there was Robert and Saurabh that also wanted to add on this.
Sure, I would just add it again. This is not about government policy, but rather focused on market efficiency. I would say that the recent consultation of TCFD to acknowledge that while its initial recommendations, I think put out 2 years ago, were very helpful in getting private sector and financial institutions to understand the concepts of climate risk and climate transition opportunity, they left it very high level for narrative and a rainbow of metrics. And that unlocked a lot of information and also created a lot of confusion. And part of our analysis is trying to draw attention to the fact that climate transition plans need to be based on clear, comparable, even scientific targets, interim targets, and the consultation that the TCFD has just put out, even last week, that will be out for another month or so, really gets into specific metrics and comparing those metrics across the world so that investors can make choices. And that's the key issue here. If you have a 20 to 30 year climate transition plan, let's allow, some investors want to invest in high carbon emitting countries, and to help them over time responsibly decarbonize and to have the capital to do it. You need capital to invest in green technologies, in renewables, et cetera. And we just want to see that markets are efficient in supporting the transition and supporting sustainability over time.
No, I mean, very interestingly, since we are discussing this, and then yesterday we had this big discussion within Mirae Asset Global on implementing ESG across the globe, and my counterparts on the fund management side were saying that you have to look at India very differently because our dependent on, say, coal will last another decade. So you have to put that in perspective. But you know what ESG actually does, and this is a very personal opinion, that all these companies which are on that side of the country, of those, say, business lines, are aware of or become aware of what they are bringing to the table. Hence, they start building synergies or strengths on the other two factors. You know, suppose they're scoring low on say the environmental side.
Okay.
What ESG then does is these companies go up 2-3 notches on the social side, on the governance side, and build a more integrated company. They are on the environment side. What can they do? And the country sort of depends on them. I mean, it's just a small thing. Any company which is today not vaccinating its employees at this moment in India, trust me, the HR manager is already under pressure. It's as simple as that. So you know, it gets into a very different sort of evolvement of the whole society that corporate India can bring through this. And it's just not about, like I said, it's not about exclusion. The companies which are low on the environmental side will go 2 steps ahead to step their act on the social side, on the governance side, to build this. I mean, that is why it is so inclusive in nature.
Absolutely. There is another question, if we can take it up, Inga.
One last question.
One last question
last
should be. Okay, great. I think this is a question which asks what is the list of activities that are covered or likely to get covered under sustainable financing or green financing for Indian lenders. Any guidance is expected in near future. So what are the steps that regulators will they come out with guidelines on sustainable financing?
So we already have guidelines on green bonds.
Right.
It came way back in 2017, where we have also given a taxonomy as to what would satisfy green bonds. And we have some issuances, although I'll not say it has gained much of traction because we have had just 5 issuances under that circular.
Right.
Sustainable financing front, we are also working on social stock exchange side, where we are coming with few very innovative products to match to basically capitalize private money and channelizing into more philanthropist aspects.
Right.
So these are 2 areas that we are working on. There are also talks on increasing blended finance. We are in talks with other regulatory authorities overseas to understand what more sustainable financial products we can bring in. So it's more of work in progress. We are doing a bit on it.
Right. Great. So I think that is concluding our session. It has been, yeah.
I think we still have 7 minutes to go, and the closing word shouldn't take so long. So maybe using the opportunity with questions still being around by the audience, we can pick up one more question until we hit 5 minutes or something. So there was one which was for Somia, which said, or maybe I'll give it to you and you can choose. Post-COVID restrictions and lifting lockdown, how can ESG assessments help the corporate sector? Any feeling, any thought?
How can ESG help the corporate sector? I think every issue that we've seen with the pandemic has meant that every corporate has had to respond in a much better way. Certainly, I think on the social side, I think that's come into the fore as a result of the pandemic. So my sense is that keeping environment aside and keeping governance outside, the S has got stressed much more. Certainly, if I look at it from a gender lens, particularly if I look at the pandemic, been much worse for women because of the sectors that they've been involved in, which is typically retail, hospitality, travel and leisure, and even around all the IT related processing work is typically, which is more administrative, which is going to move to AI soon. Women are going to get very adversely impacted. So if there was one call, it would probably be for corporates to look at the S particularly a lot more carefully on the gender lens post the pandemic.
I think that's a very nice recommendation to end this session. Is there any other comments, ideas, or anything that the speakers of today want to share or add before we would be closing the event? Nope. Okay. Then I would want to thank everybody for having been such wonderful participants and having had such a great discussion and exchange. So I personally felt the event to be very insightful, and I hope even the panelists as well as the attendees have felt the same. My special thanks here goes once more to all the speakers and panelists, Mr. Robert Patalano, Mrs. Ravi Gupta, Ms. Somia Rajan, Mr. Swarak Mohanty, Mrs. Ruby Oja, and Mr. Shankar Chakraborty, and also Mr. Suman Chaudhary, and all the team that has been there in the background, working hard in order to make this happen, and it runs smoothly. So thank you to all of you. Also, thank you to the audience for your active participation and posting questions and really encouraging us to think and answer your queries. And I really hope that you have gained some important insights from the discussion. The full recording of this event will be available on our YouTube channel, which is Akwete Smera, so that you can share it with your colleagues in industry network. And if you wish to know more about ESG Risk AI, then you can always visit our website, ESG Risk AI, or you can also just get in touch with us. Generally, I'd request you to stay tuned and follow us on LinkedIn and also the other speakers and participants to see what's happening in the ESG front, on the ESG front, and get updates on webinars and events coming from our side of other stakeholders, and keep abreast with the industry moving forward. So we really hope to see you soon. And thank you very much to everybody for this wonderful online event, and have a beautiful rest of the day.
Thank you. Thank you.
Thank you, Inga.
Thank
Thank
you.
panelists.
Bye.
Thank you.
Thank you.
Pleasure. Thank you.